Hi, everyone. Thanks for joining. We're going to get started in just a few minutes, allowing a few more people to hop on.
We're getting a bunch of questions about the sound. So the sound is working. We're just not speaking. I think
Yes,
we're waiting.
we're not speaking. Yes, but we're probably going to start in 30 seconds.
All right. Thank you, everyone, for joining us today. The slide deck can be found in the handout section of your webinar toolbar. Please also use the questions section on the right-hand side to ask questions throughout the presentation. We'll be holding and answering all technical questions for the end of the presentation. We will also be sharing the slides and the presentation video recording link following the live presentation.
Okay, thank you. And again, this is Frank Boudelet. Welcome everybody to Withum's latest PPP loan forgiveness. Disclaimer: this content is for general purposes and should not be used as a substitute for individual tax advice. Speak to a qualified tax advisor. The content presented are the views of the authors, the four of us, and does not necessarily represent the views of or professional advice of Withum Smith & Brown. So next slide, please. So the presenters for today will be myself, Frank Boudelet. We have Lou Young. We have Daniel Mayo and Matt Walsh, all part of our SBA team here at Withum. I will alert you to the slides. We're going to, obviously there's a lot of slides. We're going to get through all of them. At the back of the slide deck are reference slides. We thought that rather than cover some of the information that we cover every time, it's in the back for your review at a later date, or if you want to refer to it. We will be taking the questions and answering them at the end of our presentation, so keep them coming in. And without further ado, I will turn it over to Matt.
Thanks, Frank. Hello, everyone. Hope everyone is doing well today. So to kick us off here, we just wanted to kind of remind everyone where we were with the PPP and where we are today. I think the top part of the slide kind of covers everything that has been covered ad nauseum and many webinars that many of you have joined and over time. So I really just want to focus in on one thing on this slide, and it's towards the bottom, and it has to deal with the Paycheck Protection Program loans that were issued. With a lot of the media surrounding the Paycheck Protection Program and the news out there, it's a lot of it focuses in on the larger loans, right? So it's really easy to forget the real breakdown of where the loans actually went when they were issued. And what we have down here is just a couple of stats here, right? So over 87% of the loans were under 150,000, and over 95% of the loans were under 350,000. Right. So while a lot of the focus from the SBA and the Department of Treasury and the news we've gotten have been on those larger loans, the reality is that you know, the makeup of the loans does represent the population of small businesses out there, right? We know that about 90% of small businesses across the country have 20 or fewer employees, and they would most likely fit into these ranges of loans under 350,000. So next slide, please. So where we're going to kick it off today is with the loan forgiveness applications, right? We are in a spot where many of you have completed your covered period, you know, through 24 weeks. We're at a spot where many of you are in the process of engaging with your lenders on what the loan process is going to look like, the loan forgiveness process rather, and you're faced with the decision now of which application form to use. And we know that there are now 3 applications out there. For the longest time there were 2, and we got a 3rd application here about a month ago, and that was the form 3508S. That's the 3rd bullet down here. So I'll start with that one because it's the most exclusive form, so to speak. So that 3508S was released in early October. It's for borrowers only whose loan is less than $50,000 and when they don't have affiliated loans in excess of 2 million, right? So this is for those smaller borrowers. You know, again, this still does affect a majority of the loans that are outstanding, and it is a simpler process. That application does allow you to just enter the amount of loan forgiveness. You still have to provide the support, but it is for the loans under 50,000. There's 2 other applications, right? And this is where we receive a lot of calls and discussions with our clients around, because the distinction between these 2 forms is pretty good. You know, the form 3508 is colloquially called the long form, and the form 3508EZ is our easy form. Right? The big difference between these 2 is whether or not you need to provide the FTE calculations and the additional schedules that are found in the long form. So the long form is the default application for all borrowers who don't meet the qualifications to utilize one of the other forms, right? So if your loan is above 50,000 and you can't use the EZ form through one of the necessary certifications, you would default over to the long form, right? So with the EZ form, you would need to meet one of 3 options to qualify. And the benefit of using an EZ form is that you're not required to submit the FTE calculations and the wage reduction calculations, right? So that FTE calculation is one of the larger and you know, and more complex areas of the Paycheck Protection Program and the loan forgiveness process. So you know, that's definitely desirable for borrowers to try to avoid that, right, where they can. One important thing to note is that, you know, while the SBA does have the authority to oversee the process of the loan forgiveness, they can't change the law itself, right? And the CARES Act itself requires that all borrowers who are seeking forgiveness do provide supporting documentation to prove that the expenses were legitimate and met the qualifications of the program. So no matter what happens, whether or not you're filling out the form 3508S, EZ, or long form, you will need to provide supporting documentation for your lender. Next slide, please. Once we get into the conversation around which form to use, we say, okay, well, what can allow us to use that EZ form? And here are the 3 certifications a borrower would need to meet at least one of these certifications in order to use the EZ form. The first one is not as applicable anymore since we now have a form for sole proprietors for those who received under $50,000 of a loan amount. That's the 3508S form. But if you are a self-employed individual, independent contractor, or sole proprietor with no employees, you can use this form automatically, right? The next one is sorry, can we go back one slide? Thank you. So the next option here is the second certification, right? And it's 2-prong, and both of these, the second and the third options are 2-prong. You have to have met both sides of each certification. So with the second option, the first part of it is that the borrower did not reduce the annual salary or hourly wages of any employee by more than 25% when you look at the covered period and what you paid them during the covered period as compared to Q1 2020. One important thing to note about this certification is that we have a lot of confusion around this because the way that it's worded just on its surface doesn't necessarily provide the insight into whether or not an individual who had been furloughed or had left would have to calculate the salary and wage reduction. And thankfully, we've gotten some further information from the SBA, and they have said that the extent to which you would need to apply this is the extent which an individual's reduction in their gross wages do not relate to an FTE reduction, right? So put more simply, if you did not reduce the rate of an individual employee or the annualized salary in which you were paying them for the weeks in which you paid them, then you wouldn't have a salary or wage reduction, right? So if you had an individual who was making, $1,000 a week during Q1, and you continue to pay them $1,000 a week for the weeks that they worked for you during the covered period, you would not have a salary and wage reduction. Similarly, with an hourly employee, you were paying somebody $25 an hour during the covered period. They may have only worked for you for part of the covered period, but you continued to pay them $25 an hour for that time frame, then you would not have a salary and wage reduction. The second part of this option 2 to get into the easy form is that the borrower did not reduce the number of employees or average paid hours of employees between January 1st and the end of the covered period. This is a unique date range, right? We've long since known about date ranges of the covered period and comparing them to reference periods, right? And these other periods for safe harbor options, but this is a much longer range that you would need to evaluate over, right? So again, you didn't reduce the number of employees or the average paid hours of employees between January 1st and the end of the covered period. This certification does allow you to ignore reductions that arose from an inability to bring back people that you had on staff during pre-COVID that you offered to return and they refused. So there is that opening there, but there's a lot of ambiguity about this specific language, and we don't have any further clarification outside what is in this form, right? So we do see that this certification is a little bit difficult to make for companies who have had some furloughs as a result of COVID, right? That they weren't able to bring the people back. As we know, the Paycheck Protection Program covered about 2.5 months worth of payroll, right? And for many borrowers, the covered period is 24 weeks, which is far in excess of that. So to the extent that furloughs existed, it may be difficult for a borrower to make this certification. The third option, which is something that, especially in the Northeast, we've seen a little bit more prevalent, and as well in California and other states where we've had a lot of governmental orders for shutdown. But the third option here is that, again, the first prong of it is that you didn't reduce the annual hours or hourly wages of employees by more than 25%. The second prong of it is that the borrower was unable to operate during the covered period at the same level of business activity as before February 15th, and that would have to relate to requirements established or guidance issued by the CDC, OSHA, or the Department of Health and Human Services. And the reason that your business activity would be down you have to be able to draw the line to this guidance and to you complying with to the company complying with the guidance that was issued, and it has to relate to COVID, right? So this language, again, a little bit curious, right? Because many borrowers after this came out were left in the stance, well, look, the CDC didn't come in and shut me down. The CDC gave guidance, and then my state or local government issued guidance that made me follow the CDC orders and shut down or have only X percentage of individuals in my location. So the SBA did come out with some clarifying guidance on that and said, yes, we realized that the state and local governments in most cases were the authorities that pushed out guidance that referenced CDC. So provided that is the case and you had to comply with state and local government orders during your covered period, that this would apply to you. So those are the certifications. If you can meet one of those three, then you can use the easy form, and if not, then you would be defaulted into the long form. Next slide, please. So we just wanted to level set here as we come in and say, okay, well, what does the process look like from a loan forgiveness perspective? Once you decide what form, you complete the form, you submit it to your bank. The lender technically has 60 days from the date of receipt to review, approve, and push to the SBA. Once the lender has approved and pushed to the SBA has a 90-day window. One important thing to consider, and this is relatively new, is that the SBA did let lenders know that when they're receiving applications, it's expected that for many borrowers who utilize the 24 weeks, they could very reasonably have a lot more expenses than the loan amount. They do not need to review any expense detail that you provide to them in excess of the loan amount. So once they get to the loan amount that, you know, let's say you have a loan of 500,000, you have payroll for $1 million, you give them payroll support for $1 million, they could you know, look at that and then not look at anything further, right? The decision that you will get ultimately will come from your lender. It will be after the SBA issues its approval to the lender. It can be approval in whole, it can be approval in part, it can be a denial, and it can be a denial without prejudice pending SBA review. The borrower does have it, you as the borrower do have a chance to appeal, you know, if it comes out in an unfavorable manner. Finally, another question that we get about the process is, all right, well, I have all this stuff together, I'm done my 24 weeks, but when is the due date, right? My lender's calling me, telling me I need to get this in. I want to get this in for various reasons, which, you know, we'll certainly address later in the presentation. But technically, there is right now no due date for the loan forgiveness application. One thing that is important to remember, though, is when the payments start. So if the borrower does not apply for loan forgiveness, then the deferral period for payments ends 10 months after the end of your covered period. So if your covered period ended today, 10 months from today, if you haven't applied for forgiveness, you would have to start paying back the loan, right? If the forgiveness is denied by the SBA, or you get your forgiveness decision in part, right, the repayment ends, the deferral period ends at that point, and repayments would begin in line with whatever the amortization schedule that the bank would provide to you at that point. So with that being said, I'm going to turn this over to Lou Young, who is going to take us through some of the payroll provider reports and then the Form 3509. Lou?
Thanks, Matt. Matt mentioned the supporting documentation that you need for the application, and many of the borrowers are relying on payroll reports from their payroll providers or PEOs to provide this documentation. We're seeing a lot of this used, especially for the easy forms, on the calculation and the documentation that you have to provide to the bank. So the interaction between you and the bank, especially if you're using the easy form, is definitely comes through the reports that you need to get from your payroll providers. Unfortunately, we've talked about this a lot. We're finding that these reports from the payroll providers are not necessarily accurate, and it's pretty much across the board. We're finding problems with the FTE calculations. In some cases, they're not calculating the wage reductions properly because they're not looking at the weeks that the employees actually worked. They're looking at the entire 24-week period. So there's some calculation issues. And the earnings codes aren't always properly included or excluded, particularly for employers with large number of earnings codes. It seems to fall into, especially with the overtime codes or some of the non-traditional codes. So, you know, we're seeing all kinds of things. We're seeing payment based on hours. We're seeing payment based on mileage. We're seeing payroll based on different items. So you have to take all that into consideration when you're looking at these reports and the submissions to the banks, as well as the calculations that you're doing. Next slide. So the SBA stated back in May that they will be reviewing loans $2 million or more, as well as loan forgiveness. So this sort of was a shot across the bow when we first saw it. And we brought this to the attention of our clients. I think it's important that any client with a loan over $2 million, the way we've been treating it, you know, you must apply for the forgiveness with the consideration that you probably will be audited. So you have to have all your ducks in line, your I's dotted and your T's crossed. So we want to be very careful to make sure that these larger loans are in fact properly executed, the forgiveness. SBA will be reviewing whether the borrower had a good faith basis as of the loan application date to represent that the current economic conditions made the loan necessary to support the ongoing business operations of the applicant. Very important, because we're going to be talking about this necessity test coming up here in a second. And I just want to repeat that again. The only thing that you had to certify on your original loan application was that current economic conditions made the loan necessary to support the ongoing business operations of the applicant. So that's very important. The loans under 2 million will be deemed to have been made, have made the required certification concerning the necessity of the loan required in good faith. So anything under $2 million, you will be certifying that you needed the loan in good faith. But over 2 million, we now are getting some clarity on exactly what the SBA was looking for. They have instituted 2 new forms that were circulated in late October, the Form 3509 and the Form 3510. And these are affectionately known as Loan Necessity Questionnaires for profit and nonprofit borrowers. Go to the next slide. So there's a lot of small print here, but the forms, these forms are going to be provided by the bank. So they are technically, they're not out yet, but we have heard that some banks are issuing them, showing them to clients, showing them to their customers. So we are starting to see some of these out there. I know we have several clients who have looked at them and have started filling them out just to get a feel for what questions they need to answer and what information they will be needing to provide. The first section is called the Business Activity Assessment, and there's several questions in there. The most prevalent one, the first one, is a comparison of your gross revenues second quarter of 2020 to second quarter of 2019. So that's basically the revenue comparison that they're looking at in this questionnaire. The other questions in this section: was borrower affected by a shutdown order? Has the borrower significantly altered its operations? Did the borrower begin any capital improvements between 3/13 and the end of the covered period? And a catch-all request for other information reliant to any of these questions. And I'll touch on that point in a second. The second section is called the Liquidity Assessment. And in this, they start off with a request for your cash or cash equivalents on hand as of the end of the first quarter, 3/31/2020. The next one: did the borrower pay any dividends, distributions, other than pass-through estimated tax payments between 3/13 and the end of the covered period? Did the borrower prepay any outstanding debts between 3/13 and the end of the covered period? During the covered period, were any employees or owners paid more than $250,000 on an annualized basis? If so, how many employees and what was the total amount paid? Was the borrower a public company as of the loan application date? Did the public company own 20% or more of the borrower as of the loan application date? Was the borrower 50% plus owner by another company as of the application date? Was the borrower a 20% plus owner owned by a private equity venture capital hedge fund as of the loan application date? Was the borrower 50% plus owned by a foreign or state-owned enterprise? Did the borrower receive any CARES Act funds other than the PPP, excluding tax benefits? And in that case, I think we're talking about the EIDL loan. And another catch-all request for information relevant to any questions. So I guess the interesting part here is the cash and cash equivalent on hand. There seems to be some concern about businesses that may have had 1, 2, or 3 times the amount of their loan proceeds in capital and cash. So again, we're not sure where the SBA is headed with this in terms of how they're going to assess necessity. But I will tell you this, there has been quite a bit of pushback on this, especially recently. I know that several national organizations have made comments to the SBA. And I think there's a couple things that do need to be noted here. When this form was when we originally applied for the loan, this was an 8-week program, not a 24-week program. So there was a lot of economic uncertainty at that time. The beginning of April, the end of March, there was a lot of concern. People didn't know what they were doing. They didn't know whether they needed to furlough employees. They didn't know what their capital needs were. They did not know what their sales situation would be going into late spring, early summer. There was a lot of confusion. We all remember that. But you'll notice in this form, there's not a single question that addresses whether or not you furloughed any employees or you brought them back or you kept your employees as part of the PPP program. So again, there is some pushback at this point, and maybe the healthy revenues and the liquidity that you had was because of the success of the PPP program. So you know, it's hard to put yourself in the SBA's position to say that this loan was necessary. You sort of have a self-fulfilling prophecy. The success of the program may have led to the healthy aspect of some of the businesses that got the loan. So I think it's going to be very difficult for the SBA to come back and have any kind of pullback or discussions or audits with regard to the loan necessity, especially in the Northeast where we are here today. Again, I mentioned, you know, if you get a chance and you have a loan over $2 million, you want to take a look at this form, fill it out ahead of time, get comfortable with it. And as Frank has pointed out, there are some provisions, there are boxes for comments in the form, in the questionnaire. So it's a good opportunity for you to document some of your thoughts on each of these questions. And you know, there may be some stipulations that you want to add, some caveats, conditions that come into play with each of these questions. The comments can be put in. There's plenty of room for comments at the end of each of the sections. So I think that's very important too. Go to the next slide. So again, when you get this form, technically you're supposed to respond within 10 days of the receipt. Again, that will be between you and the bank. The bank will and should be giving you disclosure on this, instructions on what to do. And as I pointed out, a number of national organizations have been submitting comments on these forms. And it's interesting to see these comments that sort of call into question putting a form out like this after the fact instead of at the time that the loan was originally applied for. So I think that's important. The other disclosure issue that's come up, there was a request for the disclosure of names and loan amounts for all borrowers under the two SBA programs, the PPP program and the EIDL. Just recently, there was a temporary stay granted by the courts, basically putting a freeze on any disclosure at this time until December 7th. So this is under appeal. We'll be learning more about this. I don't know if you remember, but originally there was some disclosure in July with regard to aggregate data, loans under 150,000, above 150,000. and there were borrowers' names and ranges of the loans provided at that time. So there has been some disclosure out there, but we are seeing a stay for the release of this information, the specific information, until the appeal process is addressed. So with that, I think, Dan, why don't you take over and discuss some of the tax issues?
Great, thanks, Lou. So we're going to talk about the tax consequences of getting a PPP loan and loan forgiveness, as well as the recent guidance that came out 2 days ago, which I know a lot of questions have come in about that. It's a very hot topic. So first of all, when the taxpayer receives a loan, there's no tax consequences on receipt of a PPP loan. This is the same with every other loan that a taxpayer receives, because there's an obligation to repay. If in fact, though, a loan is canceled, which is what happens with the PPP, that would give rise to taxable income. So generally speaking, the cancellation of debt would give rise to taxable income. It happens not to be taxable in the case of a PPP loan because of the CARES Act. Section 1106I states that there'll be no income inclusion as a result of forgiveness of a PPP loan. So the loan is effective, it should have been tax-free, and that's what was intended by Congress, at least according to the many Congress people who have spoken out about their intent in signing the legislation. The problem is the CARES Act didn't address the expense side of the equation, it only talked about the income side. And the IRS issued this notice 2020-32 back in April that talks about expense disallowance and says if you have expenses relating to a loan forgiveness, which is a form of tax-free income, right? Because we know from the CARES Act it's tax-free, that those expenses will be disallowed and not deductible for US tax purposes. So that's what that notice said. And then the guidance that came out 2 days ago, we'll discuss that, the notice, but the guidance follows the recent revenue ruling and revenue procedure follow this notice 2020-32. I know a lot of people, there were some comments submitted, people in public articles, etc., written to criticize the notice and say that they didn't believe the analysis was correct. The IRS heard those comments and rejected them. And we turn to the next slide. We'll see it expanded upon that notice, first with revenue ruling 2020-27, which again came out 2 days ago. It came out Wednesday evening. Now there are two scenarios addressed in the revenue ruling, and they're fairly common scenarios we see for the PPP. Recall that there are about 5.2 million PPP loans outstanding, so that will this affects at least 5 million people, this issue. So the first scenario is for taxpayers who apply in 2020, right? So they apply in November 2020, but they don't receive a decision until next year in 2021. And so these are addressing, by the way, calendar year taxpayers whose year ends December 31st. So in that first scenario where you apply in 2020, this year, and get your decision next year, the IRS is pretty clear, again, following that notice, that expense disallowance occurs in 2020, as long as you reasonably expect loan forgiveness at the end of 2020. And that's sort of the key thing, if you reasonably expect loan forgiveness at the end of 2020. If a taxpayer filed an application in 2020, I think you would say they reasonably expect to get loan forgiveness, right? It's an application you file with your lender, you sign it under penalties of perjury, and you state that you met the requirements for loan forgiveness. So I think most people who file, well, everyone, not most, everyone who files an application is probably going to reasonably expect loan forgiveness as of the end of the year. If the second scenario is the same results, slightly different facts. No application is filed in this year, but the borrower expects to file one next year. So they're busy, they don't get around to it this year. They file their application, let's say January, February, March of 2021. Again, the expense disallowance occurs in 2020, as long as of the end of the year, end of December, the borrower reasonably expects loan forgiveness to occur. And so what gives rise to that reasonable expectation? Well, the borrower knows the facts, right? They know that they know if they spent the money, they know how they spent it, they know if they have headcount reductions or wage reductions, and those are sort of the main drivers of the forgiveness process. Whether you have appropriate spending, either payroll, non-payroll costs, and whether there's any reductions, such as headcount or wage reductions. Almost everyone should have an ability to decide whether they reasonably expect to have loan forgiveness, particularly if you're going to file an application. So then the question is, well, who can disallow expenses in 2021? Can anyone choose not to disallow in 2020 and push it off to next year? And the answer is, only someone who has no reasonable expectation of forgiveness at the end of this year. And so I pose the question here, can there ever be no reasonable expectation of forgiveness if a borrower files or plans to file an application with its lender? You know, they're kind of disparate statements. It's hard to say you have no expectation of forgiveness if you file a form certifying that you've met the requirements for forgiveness and you're asking your lender and the SBA to approve your application for forgiveness. So I think the borrowers need to consider when they're trying to, you know, decide which year to deduct the expenses, they need to consider the statements they're making on the loan forgiveness application. They need to consider the statements they plan on making on their tax return, whether they plan to deny the expenses in 2020, and they need to consider what they're going to tell their auditor if they're filing financial statements, and whether it's probable they're going to get loan forgiveness, which Frank will talk about after this tax discussion. So next slide, please. So that was a revenue ruling. The second piece of guidance that was issued again 2 days ago was this revenue procedure 2020-51, and both documents were about 8 pages if anyone wants to look them up. This document provides a safe harbor for taxpayers to deduct the expenses relating to the PPP. So the situation here is where you have this eligible taxpayer. It only applies to eligible taxpayers. And let's talk about these 3 requirements here you need to fit within the safe harbor. One, you have to have a taxpayer who incurs expenses in 2020 and reasonably expects loan forgiveness at the end of the year, right? So that's most people, right? That's 99+% of borrowers incur expenses and reasonably expect some level of loan forgiveness at the end of the year. 2, they apply for forgiveness in 2020 or intend to apply for forgiveness in 2021. Again, that's 99+% of borrowers, so probably everybody on this webinar today. And the third requirement is one of 2 things. Either you learn in 2021 that their loan forgiveness application has been denied in whole or in part. So for example, you had $1 million loan, you filed for 100% forgiveness, but you find out in 2021 that they're only going to forgive $800,000 instead of the full $1 million. That's the first option. The second one is you decide in 2021 not to seek loan forgiveness for some or all the PPP loans. So for example, on further investigation, they determine they will not qualify. And so if you meet these 3 criteria, you're what's called an eligible taxpayer, right? So you thought you were going to get it in 2021. It turns out, you thought you're going to get it at the end of 2020. Turns out you're not going to get it, or you're going to get some lesser amount than you expected in 2021. But when do you correct for that? When do you take the deductions that were previously denied, right? So let's take the case of the person who had $1 million loan. They received a decision in, call it March of 2021, where they were only received forgiveness for $800,000. In that case, $800,000 of the expenses, $100,000 of the $1 million are properly disallowed, and $200,000 would be deductible because there was no forgiveness relating to that. So that's where the safe harbor comes in. And that last bullet here says deductions for expenses. So when can they take that $200,000? The first option is they can take it on a timely filed tax return for 2020. Well, how would that happen? That would happen only if they got the decision before the due date of the tax return. You could fix your 2020 tax return and do it that way. 2, if you already filed your 2020 tax return, you can amend it, and you can submit it on an amended return. And 3, you can deduct the expenses on your 2021 tax return if you file a statement with the return. And there's 7 things you have to put in the statement. It's not complicated. So what's helpful here is that Safe Harbor provides an option for taxpayers. You can, if things didn't turn out as expected for one reason or another, you can deduct the expenses either in 2020 or 2021, whichever is more favorable. So it may be that you have a loss in one year and income in the other year, so you prefer to take the expenses in the year of the income, right, to lessen your tax or maybe get a refund. So that's the nice thing about the revenue procedure, is that if things don't turn out as expected, you can choose the year in which you make the expenses deductible. So with that, I think I'll turn it over to Frank now to talk about the accounting treatment.
Great. Thanks, Dan. And I'm going to do this quickly because I know we want to get there's a lot of questions coming in. And I'm an audit guy, but I do like the accounting treatment. So the AICPA issued a Q&A section 3200.18 loan debt. Really and there's a link there on the slide. You can click that and get to the actual, it's about a 4 or 5 page document. but there's two alternatives for accounting treatment of the loan, of the PPP loan. One as a traditional loan, and two as a grant method. And a lot of nonprofits might look towards the grant method. For-profit entities can use the grant method as well. We'll talk about that now. Next slide, please. So under the loan method, the borrower records the loan and accrues interest at the 1%. You do not impute the interest because it's a below market rate. The loan stays on the books until it's legally released from the SBA. And we have had some clients that have gotten the release from the SBA, that they've gotten approval. So when you get that document from the SBA, it's approved, then you can remove it from the books. When you're using the loan method, you'll have a gain on debt cancellation, will hit your P&L. Next slide, please. The grant method. A lot of nonprofits will use this, but for-profits can as well. GAAP doesn't really have anything in its guidance, so we look to the International Accounting Standards 20, which talks about the government assistance. And here, it's not recognized until the grant is reasonably assured. So you have assurance that you got the grant because you got the money, and they use the word, reasonable assurance as opposed to probable. The conditions to be met are economic uncertainty, which is the reason why you apply for the loan in the first place, and then you met eligibility requirements. So if you meet those two, then you meet the requirements for a grant. Next slide. So when it's a grant, what happens? How do you record it? Well, the PPP loan is recorded, you get cash debit, and then you credit deferred income liability. And then as you spend the money towards an allowable expense, payroll and non-payroll cost, you would, obviously you pay down, the liability goes, the expense gets recorded, so you hit your expense, and then you reduce the liability by the same amount, and you'd have either hitting the income statement for that account, like if it's payroll, you can hit it, you can reduce payroll for the amount that you spent, that you're getting forgiven, or you can put it in the cancellation of debt. So that's you'll be systematically over the time that the loan is outstanding. For those that have an interim, their year-end, fiscal year-end is say September, and you're still spending the money, you'll wind up with a balance on your balance sheet at September 30th for the deferred liability until you spend the rest of the money, which may happen in say October. Next slide, please. And I am going quick over this because I know we have a lot of questions really dealing with the loan and the forgiveness. There are disclosures required for your financial statements. Again, you can read through the slide here, but it's a loan, it's legally, pay until you get the legal document. So even if you're using the grant method, you still should have disclosure on how you're recording the forgiveness income amount or the debt cancellation amount, and describe exactly how that's being performed, and then also describe that that the amount is outstanding until legally forgiven by the SBA. And also note that there is 6 years that the SBA can come back and audit your certification. So you still want to have that disclosure. You may want to have that disclosure for the next 6 years because there is a chance that you'll have to have that reversed. Personally, I believe that we should keep them as loans, especially with that necessity form that came out. So if you're having your financial statements audited and you're filling out that necessity because you have over a $2 million loan, you may want to keep it as a loan rather than have to claw back income in case the SBA denies your loan. Next slide, please. So some changes that are coming down the pike. The HEROES Act, which is sitting out there in the Senate and the House hasn't approved. What they want to do here is have a second round of PPP. They're going to limit it to borrowers under 200 or fewer employees. Before we had the 500, so it's really for smaller businesses. They're also talking about a 25% reduction in gross revenue in Q1, 2, or 3 of 2020 versus the same quarter of 2019. So again, that's the first time we see anything other than the necessity form that talks about having revenue as a requirement for applying for the loan. The loan size will still be 2.5 times your monthly payroll cost, up to $2 million cap. Again, these are for smaller businesses. And there's potential to expand the non-payroll cost to cover PPE and some other costs for adapting your work environment for working at home. So that's on the pike. We're not sure where that is in the process. Hopefully we'll hear more when the office gets turned over and Congress can get together on that, because businesses definitely need the money. I'm gonna now, next slide, turn it to questions. But I do want to say that we are preparing calculations for our clients. We're also reviewing calculations. So if you have some of these questions, I see here some clients, if you want, reach out to the partner in charge of your account and have them turn it over to our team. We have plenty of folks in-house that are currently preparing the, like I said, preparing the loan calculations, forgiveness calculations, and also reviewing the ones that you've prepared. So with that said, next slide, please. We'll get into the questions and answers. So let me get to the top and see what kind of questions we are getting. I'm sorry. So there was a question here on, I'm sorry, Matt, did you see any? I should have had you go first. Okay, so I'm sorry, I'm a little disjointed here because the screen keeps popping. So the payroll for the 24-week period selected is more than the loan amount that we need to submit. So do you need to include other expenses? So do you stop at just the payroll, or do you add all the expenses?
Yeah, this is a good question. I'll take this one. We've gotten quite a lot of borrowers who are choosing to include only their payroll costs, right? So over a 24-week period, it's more than reasonable that you could have 2 or even 3 times the amount of the loan in just payroll costs. As the borrower, you get to choose what expenses you include on the loan forgiveness application. So yes, the answer is absolutely yes. You can stop after payroll costs and not include any of the non-payroll rent or utilities. We're seeing a lot of people doing that because, quite frankly, it's just easier, right? You don't have to pull all of the invoices and the lease agreements and proof of cash for all of the non-payroll costs.
Any advantages or disadvantages to applying for forgiveness in 20 versus 21? When should you apply for forgiveness?
I mean, I'll take it. I'm sorry. You know, I mean, I'm suggesting to all of our clients right now that they should apply as quickly as possible. I don't see any disadvantage to applying in 2020. I don't see any disadvantage in applying as quickly as possible. Keep in mind, as Matt pointed out, there's a 60-day window that the borrower, well, the bank, I should say, has to process the loan and get it to the SBA. The SBA has another 90 days to reach back to the bank to approve it. So I think we want that process to start as quickly as possible.
Also, it's important to note there's no impact on the tax consequences. As we know from the revenue ruling, which confirmed the notice, the same tax issue either way, so there's no benefit from a tax point of view.
Have you heard from clients that even though they qualify for the EZ form, that the banks or lenders are requiring them to fill out the long form?
Not really.
I haven't heard that either.
Nope.
No, I haven't heard that.
Okay, here's a question here that they set up a separate bank account to keep the funds in, and the basic is you don't have to segregate the cash. All you have to make sure is you're accounting for the expenses that you spent. So you don't need to have a separate account set up, and you don't look to that account at all. If an employee leaves on their own, do we need to replace them? And does that disqualify us from using the EZ form?
No, I mean, again, Matt went through the stipulations. The only thing that you would need to show is that while they were working, you didn't reduce anybody's wages or salaries by more than 25%. So again, we stressed this before, but the attention is paid to the employees that are actually working, the weeks that they are actually working.
Right. Yeah, and just to add on, when you get into the long form, right, there are exceptions offered to you for the employees that leave on their own volition, for the employees that are terminated with cause, you know, and the employees that you offered to return to their normal hours and did not return. So you would get an exception for the amount of the FTE that they voided out by either leaving or terminated for cause or did not return.
So if the business was shut down due to government regs, but they opened up an online business to keep the business going, can they still check that box, the third box on the EZ form, that the business had an impact below February 15th?
Well, I'll take that one here. It says that, I'm looking at the rep right now, it says that the business was unable to operate at the same level of business activity. So they don't describe the type of business activity. So it's not like you can't do A anymore, but you can do B. You have to look to the level of business activity. So I would look at revenue as a proxy for that, right? It might be a good way to do it.
Right. If you're using the 8-week calculation, do you still have 10 months? I assume that's 10 months to before you have to apply for forgiveness. I think, Lou, you hit that one.
Yeah, you do. You have 10 months after the end of your covered period. Most people, if you got the loan, I think before, there's some date in there, August maybe, you default to a 24-week covered period. So you do have 10 weeks after the 24-week covered period. So if you apply with an 8-week covered period, I don't think that would be shortened, but hopefully most people are not bumping up against that 10-month limit. And we're not recommending anybody wait that long. We simply highlight that as when the loan will start to become repayable.
Okay, if I have already applied for forgiveness of my loan under $2 million, will I still need to complete the loan necessity form?
No, you will not have to. I mean, that our understanding is that it only applies to borrowers with loans over $2 million.
Right. There's a question here. Do we know if the SBA is specifically denying forgiveness based on the loan necessity form answers? And as far as we know, only had one client actually get the form and submit it back to the SBA. So we don't know what they're going to do with that necessity form. I believe the necessity form is going to be used for when they decide for loans over 2 million, which ones to audit.
Right. Yeah, and it says the instructions to the form itself, for what it's worth, do say that the form in and of itself is not going to be the determinant by the SBA. It's going to be used to review a totality of the circumstances for an individual borrower.
Yeah, on that point too, I'll just add one more point. My own personal view is we don't think that this form is setting forth new rules or new requirements for this certification. You know, it's a form to collect information. It's not an interim final rule. It wasn't a rulemaking document. So it's solely a collection form of information. As we think it will be used to complete the picture for the borrower and help the SBA assess which borrowers they want to go after and which ones they don't want to waste the resources on.
Are all banks using same forms? And the answer is most of the lenders have their own portals set up. So you'll be filling out the bank's portal typically. You'll obviously use the forms that the 3508 form or the EZ form as to refer from, but the bank will have a portal for you to typically answer the questions and fill out the calculations. They'll also have a place for you to probably upload the documents as well, which you'll have to submit.
Correct.
Let's see. Do you feel there's a possibility of Congress overruling IRS's authority to disallow expenses from PPP forgiveness? Dan?
That's anyone's guess. I mean, at some point we thought it was likely. At some point we thought it was unlikely. I just read today that Mnuchin, was restarting talks with Pelosi and Schumer. So, I mean, this is on the table for the next stimulus round. Whether it makes it in is anyone's guess.
Okay. If we laid off staff between January 1st, 2020 and end of the covered period and did not offer that to rehire them, however, we hired other employees during the period, so we have the same or more number of employees. We did not decrease anyone's salary during the time. Are we allowed to use the EZ form? That to me sounds like yes. You haven't reduced the number of FTEs. You're allowed to replace employees that left or that you terminated since you have the same number that you had prior. yeah, the easy form is appropriate.
And again, there's a second component there. You have two choices. You have an FTE certification or a business activity certification. If you have any questions about your FTEs between January and the end of your covered period, you probably should consider the business activity certification as an alternative to get to the easy form.
Here's an interesting question. We are a nonprofit that received a PPP loan in excess of $2 million, but we'll be seeking forgiveness for only about $500,000 because our anticipated grant funding shortfall turned out to be less than expected. Can we pay down the loan to $500,000 now to avoid the extra documentation requirements? So I guess
Probably not. And the reason for that is because the way that they are generating who will need to fill out the 4509, and for not-for-profits, it's the 3510, same, same form with some specific questions for not-for-profit organizations. They're going to be going by the SBA loan value, right? The amount that was issued by the SBA to a borrower. At this point, probably the only way to be able to get out of that would be to have that value changed. And I think for most lenders, they've already filed the requisite forms finalizing the loan dollar value.
Yeah, I agree with that. The loan is based on the initial loan, not the repaid amount. It's not a sliding determination where you pay some down and then they'll assess it. They ask what was the loan you achieved, you obtained, and that'll be it.
if an employee is on leave of absence, does the employee count as an FTE?
The way
still
that
employed by the, yeah, if they're employed by the company, the business, then yes.
Yeah, I think it all ultimately will depend on whether or not they're, whether, because an FTE is calculated on hours paid or hours worked. So if they're still getting paid, then yes, yeah, they would be considered an FTE.
I received a $20,000 EIDL loan. However, none of it was earmarked as an advance. Therefore, I wouldn't disclose that on my application. Is that correct?
Yes. You don't have to disclose the, they ask you if you got an EIDL loan, I think, on the application, but they don't ask you if you got a grant. I don't think. The SBA has that information on its own. Either you guys recall that?
Yeah, so if you get,
Go ahead, Matt.
I was going to say, if you get an EIDL grant, the SBA has a matching system on the background that will match it against your loan forgiveness application. So I think it does ask you for your EIDL advance amount, but what's going to happen is they're going to automatically reduce any forgiveness amount that they authorize to the lender by any EIDL grant. They have a matching system in the background that they, I think they announced that like early October maybe, or late September.
Yeah, they don't require the advanced amount, Matt. You're right.
Yeah.
I only had one employee, but she was paid by 1099. She has been paid that way for 4 years. Is this going to be a problem? Yeah, the problem is that 1099s do not count towards the forgiveness. So her compensation is really as an independent contractor, so that will not count towards the amount of money that you would get forgiven.
And technically, you shouldn't have even gotten the loan based on the 1099 employee, right?
Correct. Yes. They shouldn't have been on there in the first place. We did know that some banks were taking the 1099 information and adding it in. One of our thoughts is that you might want to think about discussing that with your counsel. If you applied for a loan that included 1099 individuals, you got more than you were supposed to get. Now, when you apply for forgiveness, it's a good possibility that because even though you exclude the 1099 people, you still will have enough to get fully forgiven. Our recommendation is that you might want to discuss that internally and see if you might want to give some of that back, because some of the money was improperly calculated and not gotten according to the SBA rules. There's a question here. How will lowering payroll for forgiveness affect my 199A calculation? If anybody knows that, if not, we can move on.
Yeah, we've looked at this one. The 199A calc is the QBI, qualified business income, and in order for wages to count, you need to get a deduction for the wages. So if you're subject to the wage limitation for QBI, your wages will not include the wages that you use that are disallowed as deductions for PPP purposes. So it will reduce your wage limitation. Your wage limitation will be reduced to the extent those wages are not deductible.
Can you talk more about detail expenses are not able to be deducted? If loan is forgiven, does that mean that you cannot use the payroll as an expense during the period?
Correct. Whatever expenses you put on the application will be disallowed. That can be, so you can use up to 40% non-payroll expenses. If you want the non-payroll expenses, the non-deductible, you would include them first, right? And then the payroll after that. And what we're advising clients is to prepare a statement ordering and listing an order for the expenses in which you're asking for disallowance, for forgiveness, so that you can order those expenses for purposes of QBI, for example.
Right. FTE employees should be listed and their hour rates of pay are needed. The larger payroll processors have reports as needed, but you indicated they are not correct in some cases. Smaller clients do not always keep accurate records, and the government agencies can make life difficult. That's just a discussion that there's 2 Senate bills that are dealing with $150,000 floor. So for the smaller loans, there is a bill at the HEROES Act that might reduce the any requirements to submit documentation for loans under $150,000. How do you calculate FTEs for the comparison period, not the covered period?
The manner would be consistent with the way that you calculated the covered period. The rules would carry to that period. You would select whether your reference period is January 1st, 2020 to February 29th, 2020, or February 15th, 2019 to June 30th, 2019. It would be the same way, right? Average weekly basis, FTE basis.
Okay. If you do not need 24 weeks of payroll to cover the loan amount, which is typically the case, and you use 16 weeks, do you still calculate FTE for 24 weeks for the calculation, or do you use the 16 weeks for your FTE calcs?
That's a good question. I don't know the answer to that. So normally what we were telling people was if you apply early and you're relying on 16 weeks, you do the FTE calc to the date of the application. But in this case, their covered period is likely over. Right, at this point, most people's covered period is over. So I don't know why they would apply on 16 weeks. Sounds like they're using less than all the payrolls, but I think they would still be obligated to use the 24-week covered period. That would be my guess, my off-the-cuff answer.
So then let me just ask that further, Dan. So if I have a 24-week period and I get through 16 weeks and I decide I'm going to apply after 16, because I'm gonna furlough a bunch of employees in week 17. Are you saying that I then would have zeros for the weeks that I furloughed employees till I get to 24?
No, I'm saying so if you apply in the middle of your covered period, the rule says you only need to include wage reductions in excess of 25% for the full 24 weeks, even if you apply early. So by implication, what we and others take that to mean is that if you apply early, you do not need to account for headcount reductions after the date of your application. So in that case, the advice to people was get your application in immediately before that reduction. And so let's say it was week 16, you would have your average weekly FTE calc for 16 weeks and then you stop. And so you divide by 16, not by 24 at the end of the day.
Okay.
But if you're at the end of your 24-week covered period, which again, most people are at this point, I think you would have to use 24. Not 6. I don't think you could artificially cut it off at 16.
Yeah.
Due to inability, I'm sorry.
Oh,
go ahead.
sorry. I was just gonna add on to that. If you're in a spot where you had to suffer a severe reduction in your headcount, it may be good for you to look at the business activity certification for the EZ form, which would absolve you of an FTE.
Or an 8-week covered period.
Yeah, I would agree. I mean, I think Hopefully that does not come up because you are using the easy form in this case, or taking the safe harbor on the long form.
Interesting. Due to inability to recruit qualified candidate, we are using contract staffing firms. Do those employees count towards FTE, or can we get an exception?
So those employees would not count towards your FTEs in the similar manner that those employees would not count towards your payroll costs, right? Because we know that they have to be your employees, right? As opposed to those of an outside company. As far as an exception, I think provided that you could demonstrate that you were trying to fill the role, that would be an exception. Lou, do you agree?
Yes.
We are a construction company with some union employees that are not FTE year-round. Would it make more sense to utilize the 8-week period where we employed 15 FTEs, or the 24-week period where we employed 12 FTEs and numerous part-time employees?
I can say we usually run the calculation both ways for clients,
Right.
and see which is better.
Yeah. So when we're calculating them, and again, you have the simplified method where you could take an employee that's less than 40 hours and have them as a half. But yeah, we would calculate both ways to see which benefits you. So that's another, if you want us to review the calculations, please reach out to us and we can help you with that.
And related to that too, there is a difference with whether when you use the rounding method, the 0.10, 0.2 versus the simplified method of 0.5, and it can lead to different results. In some cases, more favorable, even though you're using the method consistently, your reference period and your covered period. So we do run the calcs that way too, if we're not getting to full forgiveness. So we're going to run every permutation until we get as close as we can to full forgiveness.
Okay. Let's see, we're starting to run out of time here. If you guys see any questions that you think that are really good, but
We have a emailed question, Frank. Did you see that?
okay. No, I did not. You want to ask that?
It's a little lengthy. The specifications on the loan say that the FTEs have to be 40 hours. We are a construction company and the workers will usually work 32 to 38 hours a week because they will take Friday off or leave early. They are permanent workers, not temp. Can I use these workers as an FTE, not a PTE?
I'll start on that one. I don't think it's going to matter because you have to use 40 hours. Let's just say they're coming out to 0.6. They're going to be 0.6 in the reference period and 0.6 in the covered period. It won't make a difference. So you won't be harmed. The key is that you have to use the same method both ways. As long as you use the same method both ways, it won't matter that you're not using a 40-hour week.
Took the words out of my mouth. Thanks, Dave.
There's one question here that is a follow-up to a previous question I think is important to know. The question is, we discussed contract employees. What about employees paid through a PEO or through a co-employer relationship? And it is important to know that the SBA has indicated that if you're using a PEO, that is okay. They still count as your employees, right? There's a specific call out from the SBA for PEO and co-employer relationships.
Okay. Can you do a partial, for example, can you request only partial forgiveness rather than the whole amount of the loan when you apply for forgiveness?
Yes.
Definitely, if you're going to do that, I would have a discussion with your bank, just to make sure everybody's on the same page as to why you're doing that.
Yeah. I'd like to know, whoever asked that question, why would you want to only get partial if you qualify for 100% forgiveness? But yeah, that's probably okay.
I don't know about you guys. I haven't had a client yet who hasn't received 100% full forgiveness. Has anyone seen a client below? I know there's some out there, but very few.
I haven't seen any. We had a couple that were close, and I think that where based on the number of employees that they had, the reduction in FTEs made it come close. But in every instance, yeah, it was they got full forgiveness.
Yeah, the only instance I've seen where a borrower, and I've actually seen this question in here as well, where a borrower may not be applying for full forgiveness, at least that we've been working with, are those who are not-for-profits who have employees who are funded on other governmental grant programs, because you do want to make sure that you're avoiding either appearance or fact of double dipping between different government programs, right? You want to make sure that you're not including the same expense on multiple programs to get reimbursements. So that is really the one circumstance where I think over 24 weeks we've seen some borrowers who have struggled to get up to and above the loan forgiveness or the loan amount. Sorry.
How do you count employees' hours when hours are never tracked? Employees are paid by the mile in trucking.
That's been a common, I mean, more common than I realized.
Yes.
How about using the simplified method of 0.5 for everybody?
You could. I think we had a one where they determined what the number of hours were, how many miles they would do in an 8-day work day, and they multiplied that number of miles out by 40 hours for the week. So they came up with what they thought was a full-time mileage rate, and they calculated it that way. So I have seen that, and some of our trucking companies have done that.
Hopefully we're in these situations, they're moving to the easy form and don't have to deal with that.
Right. Let's see. Are we getting a copy of the slides to send to us? Yes, the slides are there, so you should be able to download the slides, I believe. My covered period began April 30th, and I used my PPP loan to pay April rent, which I hadn't paid yet. Will that be a covered expense?
Yes.
So they paid.
The rule with non-payroll costs, there's some clarifications, but for rent is if you pay it during your covered period or it's incurred during your covered period and paid in the next regular billing cycle immediately after your covered period, it's includable. I mean, we are recommending that borrowers be reasonable, right? It's with the 24-week covered period, it should be enough with payroll costs and normal operating expenses that are eligible for non-payroll costs to get full forgiveness.
Okay. Will an insolvent taxpayer possibly be able to exclude the PPP loan from income, that is, not have to reduce expenses deductions? Dan, you know anything about that? When you have an insolvent taxpayer, will they have to pick up or did not exclude the expenses?
Well, first of all, it's good to see you're not holding back. This is a live webinar and you're asking all the hard questions.
I don't hold back at all.
That's a good question. And so it's going to be tax-free anyway. It's the expenses that are the problem on the tax side, not the insolvency exception. So whether they're in bankruptcy or not, it should be tax-free.
Okay. Let's see here. If you have a lot, every time I go to read one, it moves. If you have a line of credit, are you expected to borrow against that before getting a PPP loan? The answer is, no. When you applied for the loan, you were based it on the economic uncertainty that you were facing, not that you had other monies you can borrow from. This new necessity loan form now starts requiring you to put some of that information in. So we're not sure what the SBA is doing with that. So that is definitely going to be something that we're going to, we'll have to wait and see what they do. Like I said, I think they're using that just to see, which loans to audit.
That's a very fact-specific question that's hard to answer, because let's say the person would have $1 million loan. If they had a 50 million line of credit available to them, well, I think they would say you didn't need the loan. But if they had a $10,000 line of credit available, they clearly needed the loan, right? It was necessary to run the business. So you can take extremes, and it's hard to answer that question without specific numbers.
Right. Here's a question. I think we're getting a few of these. If we reduce the hours but not the number of employees within the covered period, can we still use the EZ form?
Sure, as long as you are paying them the same hourly rate.
Right.
That's the key. As long as you haven't reduced the hourly rate by 25% or more than 25%.
Right, but you may have reduced the FTEs, right? Because if they were 40, now you're paying them 20, they're a half an FTE. So that will come into play when you're doing your calculation there.
But not on the easy form, obviously.
Not on the easy form, right?
Yeah, the easy form is a very fact-specific circumstance for each borrower, right? There's a lot to consider. So we definitely recommend that you reach out to your advisors on that one.
Should we do a few more questions? I'm happy to see we still have most of the attendees on the line on a Friday afternoon.
Yeah, let's keep going. I don't know, Allison, and can we keep going? If we can't, just tell me.
No, you're good.
Okay.
A few more.
All right. So if you see any, Dan, that you want to take a crack at, so I don't give you any hard ones, because every time I move, my screen keeps moving.
I don't mind them. I just was pointing out that we don't hold back here. We're willing to go live with any question that comes.
Even when our competition's on the call.
Right.
Let's see. Can you choose not to have the full amount forgiven if the increased income impacts the advanced premium tax credit? Is that something you know, Dan? I think we talked about that, right?
We talked about credits, but you can always choose to take less forgiveness. So the easy answer to that question is you can always take less. Nothing requires you to seek full forgiveness. So if you want to take less and that benefits you for some other reason, you absolutely should and can do that.
Right.
Yeah.
So
Another circumstance where this plays into is engineering firms that do governmental contracts and are subject to the FAR overhead audit rates. If that is you, definitely reach out to your advisor, because there is a cost benefit analysis, because PPP funds currently do affect your overhead rate. So we've been talking with some clients about there's definitely a critical mass and sort of a cost benefit analysis to be done for those who have FAR overhead rate requirements.
Okay, there's a lot of QBI questions here, and I don't even know what QBI stands for, so I'm not going to ask those questions.
We covered that one generally, so you can skip them.
Yeah, I'm going to skip those because I don't even know what QBI stands for. I'm sure I'm impacted by it, right?
That's the 199 Cap A deduction for pass-throughs, and we talked about that already.
Excellent. So what if the highly compensated took a cut to 100,000 annualized during the covered period, and also is capped in the comparative periods? Does this present a problem? So it sounds like somebody was making, say, 200,000 and they were reduced to 100. So they have a $100,000 reduction.
Not as long as they were making more than $100,000 in 2019. There would not be an effect.
Right. The SBA has no pity for people making more than 100,000 a year who get reduced to 100,000.
Right. And in the necessity form, the thing that caught my eye the most was that anybody making over 250,000, they want that listed, and they want to know how many, and they want to know total dollar amount. So, right. My fear is that my fear with that form is that they're really trying to get businesses to get the money back without applying for forgiveness. Another scare tactic that I think the SBA is doing. Here's a question: can you not include retirement and insurance provided in the application? So, and the answer is you don't have to include retirement and health insurance when you're calculating. What's going on? When you're calculating, again, if you meet it with just payroll, gross wages, and you don't have to include any other costs.
Yeah, we've seen a lot of borrowers forego including health insurance because the calculation to get and reconciliation to get from what it says on the invoices you get and what the employer responsibility portion is fairly complex and time consuming. So we've seen a lot of people forego including health insurance on there.
Yeah, and if you want an easy application process without getting your application kicked back or any kind of problems, just stick with the easy ones: payroll, rent.
Right.
Like cash compensation and rent.
Yeah, Matt's seen a lot. Matt heads up all of our calcs and reviews. He has the team under him working, and he's seen a lot. So let's see what else. I'm looking here for some others. We eliminated overtime for our employees. Does this affect the ability to use the EZ form?
I don't think so. I thought you looked at the base rate. Didn't we look at that, guys?
Base
Yes.
rate, yeah. So
Base
it would
rate,
be,
yep.
the look back would be to the base rate, and that would be the comparable.
And when you, right, and when you're paying them, typically if you're a restaurant and you're no longer, like for instance, tips. For tips, you would just include the base pay. You wouldn't include the tips when you're calculating the amounts of that you paid them, correct? When you're looking at reductions in salary?
When you're looking at that wage comparison, correct?
Right, wage comparison, yep.
But tips can be included in payroll expenses for the individual who just asked that.
Right.
Right.
Here's an interesting question. I'm just going to throw this out there. Would there be a reason not to file for forgiveness and claim the payroll expenses?
No.
Basically saying, I want to
No.
take the tax deduction for the payroll, so I'm going to pay the loan back.
No, because a dollar of forgiveness is worth 65 cents. Call it a 35% tax rate, and the deduction's only worth 35 cents. So you're better off taking the dollar of forgiveness.
Right. Absolutely.
Unless there's, unless you're losing other benefits, like we talked about, other credits or other government benefits, then it's a dollar for dollar reduction.
Right. Get down here. Any other new questions popping in? Let's see. If we choose a 24-week covered period, is there a chance that would preclude us from applying for a second round of funding in the event the government eventually approved a second round? You guys heard anything? We haven't heard anything that precludes you. We actually think the reason for the PPP2 is because they realized they only covered 2.5 months worth of salary for businesses. And now we're in month number 6 or 7. I don't know what number of months we're in now. So yeah, I think this is going to be add on. But again, the round 2 looks like it's going to be pushed out for smaller businesses under 200 employees.
Yeah.
And I would say too, it's highly unlikely that using the 24 weeks would preclude you, because that's what the program allows for. And most people are going to use 24 weeks. And it's not been stated as a precondition, so it's highly unlikely.
And this, and actually just to address a couple more questions that I saw through here, it would not be equitable, right? Because there is a reality that some lenders just haven't started accepting applications, and that's not through fault of the borrower that they didn't get their application in or pick a covered period before the start of the second program. So that would be concerning if there were a precondition there.
The loan necessity questionnaire, when will it become required to be completed? Well, when you receive it from the lender. So when you get that from the lender, you have 10 business days to complete and send it back with all the documentation. So we're basically advising our clients that have over $2 million in loans to start looking at that form and start gathering the data that they're going to need so they can turn that around quickly. We do know the CPA is not happy with that form coming out. I know their legal is chatting with the SBA on why they submitted it and whether it should be completed in the first place. So
while we were on this webinar, I've gotten a few emails from people saying that they have been contacted by their bank, that the 3509 form is coming, the necessity questionnaire will be coming.
Here's a question, Matt. Can you discuss the alternative cover period and when it should be used?
Sure. So the alternative payroll covered period was something that was released for administrative convenience for borrowers who had a biweekly or weekly payroll cycle. And it mattered a lot more when you only had an 8-week covered period. It should be used in situations when you want to align your payroll cycle with your forgiveness weeks. It is only for payroll costs. So if you got the loan on April 20th, so to speak, and the start of your next payroll was April 27th, right? For payroll costs, you would start April 27th, but for non-payroll costs, you would still start April 20th, the day you got the loan. Again, not something that we're seeing matter too much in a 24-week window.
Here's a good question.
The banks aren't really stressing it as either.
Right.
One good question I've seen too, which I don't think we've addressed yet, is why would you use an 8-week over a 24-week covered period? Do we address this? And one reason might be to not to have to fill out that 3509 to the full 24 weeks. So let's say you made a large distribution on week 15. If you use an 8-week covered period, you won't need to disclose that on the 3509.
Right. Good point. How are employees with base rate and commissions handled? We have employees with lower commission for some of the time. Does the reduction in commission amount to a reduction in wages for forgiveness?
No, we're only comparing base wages.
Correct. So you would exclude the commissions that they're paid.
I need to jump in 1 minute, Frank. Sorry.
No. All right. Yeah. Well, we only have 1 more minute anyway. I think we're going to have to cut this down. So I guess with that, I'll probably say close it out. So any lasting comments anybody want to give to summarize everything that you've seen today? Lou, any major thoughts you want to pass on, share?
I mean, to the extent that you qualify, we're trying to get as many clients as possible using the easy form. I think, in where we are located in our area, most of our clients should qualify for that business activity reduction certification. So, and it'll make your life easier, no pun intended, when you're filling out the application, the portal with the bank.
Dan, any closing comments, Dan?
Yeah, so most people should be getting full forgiveness, and whether that means using the easy form or looking at the FTE reduction exceptions or the safe harbors. If you're not getting full forgiveness, reach out to your advisor, push hard. If there's a reason, there's a reason, and it may be that you don't get it, you don't qualify because you had severe headcount reductions, wage reductions, or the reason Matt mentioned earlier. But it's worth double checking to make sure that you're getting the maximum amount of forgiveness possible. Matt,
any closing comments?
Closing thoughts are hopefully everyone has a healthy and safe holiday week next week.
Great, thanks. And I want to thank everybody for attending. Great questions. We'll follow our website, withum.com. We are putting a lot of information out, and we put an article out. Dan wrote an article for this new tax legislation that came out. So stay tuned. If anything new comes up in the next few weeks, we'll probably have another webinar. And if you do need to have us help you with any of the calculations or review, please reach out to the partner in charge of your account, and we'll be glad to help you. With that, everybody have a great, safe holiday, and be well.